Good morning, everybody. Welcome to the latest edition of Talking Boys, the 30th of September. It's the last trading day of the week and the last trading day of the month. So could expect some fireworks today, potentially even more so than what we've seen of late anyway.
And last show with me and Jamie on it as well.
Yes.
I'm off on holiday.
Yeah. Have a lovely time, Steve. I'm sure you will. And sadly, Jamie will be leaving us next week, moving on to a new challenge, which we're very happy for him about, and going to wish him, of course, all the very best with it. And it's been a pleasure having you around, Jamie, for the last however many months it's been.
Thanks, Joe. Yeah, I appreciate your kind words. I'm going to miss doing this talking, but I think I've been here over 100 episodes now, so it's been a pretty regular part of my morning. Um, but yeah, I'll still be tuning in to see what's going on, don't you worry.
Good, good. No heckling, please.
No
Yeah, I can
heckling,
see
maybe a
that.
little bit.
All of a sudden, we're getting some
No
comments
difficult
from.
questions.
No, I'll be good. I'll be good.
Excellent.
Brilliant.
Okay. Right, well, let's get on with the latest headlines then. Obviously, more volatility yesterday was seen pretty much across the board. And we will kick off with the news about the German inflation number that hit a record high. Prices jumped 1.9% for September compared with expectations of 1.3%. So a pretty significant move higher there. Increases jumped to fresh record highs overall of 10% from 7.9% as the ending of transport subsidies put strong upward pressure on prices. The German government announced a support package of up to 200 billion euros to subsidize energy prices, which will be paid for in part by a levy on energy producers. The government insisted that it would not be engaging in a wider expansion of fiscal policy. We'll see if there's any U-turns on that. Obviously, the Bank of England have kind of set the tone this week by stepping in with the bond markets in the UK to try and stabilise those. But we've got pretty much the US and Germany now saying that they won't engage in anything further and will continue to tackle inflation. Ultimately, the Fed still remains very hawkish, and the rhetoric along those lines continue. The Cleveland Fed president stated that the Federal Reserve was not at a point where it should think about stopping rate hikes, with the bank not even in restrictive territory. The St. Louis president stated that inflation will begin to fall in 2023, but how quickly is unknown. In the UK, the OBR fiscal forecasts are due next week. Government sources indicated that the first estimate of the OBR fiscal forecasts will be available on October the 7th, with a full forecast by the end of October. The timetable did provide an element of relief to the UK markets. In terms of what's happening with sterling, we have seen some short covering. The move to bring forward the OBR forecast provided an element of reassurance and also helped trigger a fresh round of bargain hunting on valuation grounds. Sterling dollar surged over 4 cents from the lows on the day to put a 1 week peak at 1.1200 before dipping again. That was largely in part also by the dollar correcting quite sharply. The US currency posted a significant net loss on the day yesterday as the euro engaged in a strong round of short covering. Significantly, the dollar retreated despite the slide in equities, and the dollar index retreated to a 1 week low. Still not really putting any kind of dent into the significant uptrend that we've got there. And the dollar index continues, I think, overall to move higher. It's been up the last it's been up 8 in the last 9 months. So it's looking pretty strong across the board. Some mixed Chinese data. The manufacturing PMI edged lower, back above the edged back above the 50 level for September from a previous reading of 49.4, but the non-manufacturing index retreated on the month, and also the Caixin manufacturing index dipped below that 50 level, that expansion zone, to 49.5. And we are expecting some position adjustment today. As I mentioned at the start, it is the last trading day of the month, and therefore there could be some month-end positioning and also quarter-end positioning as well, which may contribute to some further volatility in the financial markets. So that's that for the latest headlines. And now we can take a look at some price action and see how things are shaping up as we move into the last trading day of the month and the quarter and the week. And see what's happening. Steve, what's going on with cryptos?
Well, Bitcoin seems to be continuing to try and hold on around this support level, doing a pretty good job of it on a weekly basis so far. We're back above Sunday night's close, so that's a positive. We have been higher this week, and we'll show you the daily chart where we spiked higher. I think it was on the Tuesday, and but we are building a little bit of a negative formation down here. It's a intra-trend head and shoulders formation. It's called the Steve O'Hare intra-trend head and shoulders. It's not a classic one. Normally you see these at the top of a rally, a really long prolonged rally, but I'll call you back, Mum. Yeah, but we're getting this inner downtrend, and for me it's still the same type of price action, so you need to be aware of it just as much, because the extension lower could be quite aggressive when we break 17.6. I say when because I do believe we will. Still opportunity on the upside. I'm sure we'll get rallies in between, but the overall picture looks pretty damp for Bitcoin. The one cryptocurrency I'm looking at that's shining quite brightly is XRP. Again, yesterday we saw a really nice, well, it was getting late last night actually, late into the session last night, we saw that it rallied from a low of 41.90 on the day up to a high of just over 50 cents. This is formed a real nice base on the daily chart, an inverse head and shoulders, which it's already got very close to the target, got up to 56, target was 58, and that would and there's other retracement levels to look at, even up to 67. I could see that getting there at some point, but obviously if we do get some sort of Bitcoin collapse, that will drag it back. But I think this is the one to sort of like to be buying in the short term at least. So yeah, let's look at commodities. And gold has continued the rally higher. There's obviously a little bit of a safe haven play here, where we've seen a really nice reversal formation, bottoming formation, a morning doji star type formation is an inverted hammer, which isn't classic, but then the bullish engulfing the next day. Bullish, yeah, it would be bullish outside candle the next day on Wednesday. Took prices up to 1660, pulled back a little bit the next day, but we've pushed higher this morning and trading at the sort of like first level of resistance, 1670. We have resistance all the way up to 1690, so it's going to be a bit of a tough challenge for gold. Any dollar weakness will be jumped upon, I think, as this continues to correct. However, there's still a long way to go before really this turns into a buy for me. It's still within a bearish channel on the downside. I think there's still opportunity for it to go further once the dollar gets back on track, and but yeah, resistance all the way up to 1690 and further as well. So 17 for me, we really need to clear 1735 to start to think about setting longs again. So yeah, still under pressure, but seeming to perform quite well. Silver is just mimicking the gold at the moment. Again, really nice Wednesday turnaround from the support in silver. This is all the way down, all the way down to $17. We've got 18, around about 18.40 down to $17. We've got a bit of support from previous price action. And also we're hanging about, or we did break it, but we're hanging about 61.8% retracement from the highs. So yeah, looking positive on silver. I haven't really looked at gold copper recently, but copper, the same sort of price action. These precious metals and are sort of like have formed a bit of a base. That was at the 78.6% fib and marching higher today. Crude oil has also turned around, and you can see, so they're all very much related to the dollar, and the same sort of bottoming formation. Prices really to look for. A break above 82.40 would be positive. A break below $80 would be slightly negative, just on a short-term basis. And I still think we're in a downtrend. You can see a nice bearish channel here, but a little bit of light relief on the WTI crude oil. Brent crude oil levels to watch. Yesterday's high at 88.50. Break above there should lead to a further challenge, maybe up towards $92. and support coming in around about $86. A break below there, and we're back under pressure. And natural gas, it's over the last few days we've formed sort of a couple of bullish hammers, so that looks quite positive as well. Maybe formed a base here between the 61 and the 78% fib retracement. This head and shoulders formation still relevant, and still potential for further downside, but it's already broken quite nicely, about 50% of the way to the measured move target, which is 560. And price action to watch, really, a break above the 725 level, it would be positive. A break below 660 would be very negative indeed. Yeah, that's about it on the on that side of things. I mean, I could quite briefly look at what the gilts are looking at. You can see the gilt. This is a UK 10-year bond. The bullish outside candle from Wednesday, when Bank of England stepped in and bought all those lovely gilts, we saw a little bit of negative price action yesterday, but we're on the front foot this morning.
Look at the weekly chart, Steve.
Yeah.
And get a fib on there from wherever your chart goes back to. Oh no, it doesn't work.
Doesn't go back.
Well, is that a support level there though from those previous lows? Is it held?
No, it hasn't really. I mean, yeah, you'd have to go a long way back, really, probably
So
to the 90s.
those lows that you've got there in 2004 to 2000, it's going to close above that on the weekly, right?
Oh
no, it's not.
No, not well. I mean, we never know, but it's a pretty decent reversal candle. I mean, have they done enough? You might.
Well, I'm just wondering if it's a buy now.
Intervention never works. I kept saying that all week. So yeah, temporarily, I would say I wouldn't go against it.
Well, this is a chart I've got. It's the weekly chart of the IGLT, which is the iShares UK Core Gilts chart. I mean, it goes back to what 2007 here, where we have a low, and if you draw on the fibs, we've got a 61.8% fib level here that we are about to close above on the weekly with a very impressive hammer candle. If you've got the backing of the Bank of England, who are the biggest buyer in this market at the minute and going to do whatever it takes, is that a buy?
Well, also my
the yield is what, 4%?
Yeah. Yeah, I mean, 4% isn't bad, is it? We haven't had a 4% yield. We haven't seen something serious like that, especially a government bond, for a long while. This is the Bund, and it's interesting that this has just done the same. It's like you're getting a bullish hammer forming, and these are the previous lows from back in 2012. So we are at decent levels. I mean, if you take a fib all the way from there, where are we?
61.
61.8, bang on 61.8%. Look at that. Cool, you couldn't write it, could you?
No, I don't
mean,
think you could.
that's a decent move.
So risk reward there. You're buying, stop below the low, targeting a move back up to that resistance in blue you've got, maybe.
Yeah. Who knows? Who knows? You know, I'm sort of like getting a bit fed up with just watching the news, and just the whole UK news is full of like what this mini budget did to sterling. And this has been in play. This has been coming for years. It's not just happened. It's not one event. Okay, there's an overreaction from this one event, but for years we've been buying gilts, we've been buying bonds, we've been buying bunds.
Yeah. So when we stopped, the arse fell out of it.
Yeah, it's not just what happened last Friday, and people are blaming that. It's absolutely mind-numbing how people sort of think that for the last 12 years, 15 years almost, we've had sort of like, we've been able to borrow money for nothing, and they expect that to continue forever. Fucking wake up and smell the coffee. There's a price to pay for everything, and people was probably still moaning when rates were at 2%, thinking, oh my god, I've got to pay 2% for my mortgage. Really? It's sort of like, yeah, It's just the way of the world. It's how economics works. It's supply demand, and we've been doing for the last 15 years. The governments of the world have been printing money. It's like, that's what happens. What happens to most people who print fake money? They get locked up. So just because they've been doing it legally, no one was moaning really about it then. They sort of like saved the banks in 2008. If they hadn't saved the banks, you wouldn't have any savings. The banks would have gone. So,
Yeah. And now we're
people have
talking
got
about
short
pension
memories.
funds in the
Yeah,
same.
pension funds, exactly. They've had a sort of like an easy ride. I mean, it's sort of like I still scratch my head. So that they're long gilts, yeah.
Primarily,
And
I think I mean, if you think about a classic kind of 60-40 approach, or maybe they've got sort of lifestyle investment setups whereby they're based on your age. So say if you're 60 years old,
yeah,
you'd have 60% of your portfolio in government bonds and you'd have 40% of your portfolio in equities. And as you start moving higher up the age range, the bond exposure increases and the equity exposure decreases.
mm,
So theoretically, for someone like me who's 37, I should have 37% of my pension in bonds, and 63% of my portfolio in equities.
yeah.
Is
Okay,
kind
I
of a
mean
standard,
that's a
an
nice
industry
nice way to
standard.
think about it as well. That's a good way to remember these sort of things. But yeah, they've sort of like, so they've, they're the guys who are supposed to sort of like understand risk and everything, but obviously got lazy on their watch.
Mm.
And gilt prices have come lower, and they're going to be cashing them in them gilts, and there'll be like a negative return on them overall
But yeah,
because
because they won't be. They should redeem at 100, shouldn't they? Ultimately, but
yeah.
who knows? Anyway,
Anyway,
let's move on, shall we, to the FX markets, and let's start with let's get the gilt off the chart and let's take a look at the dollar index, shall we? Because not that chart, this one, the daily, because we have seen a bit of a correction. Two pretty big days, to be fair, on the downside, and potentially a third lining up here. We're only slightly higher on the session. But, this is just a fairly standard pullback, really. I don't think it's anything to get excited about. We're not seeing any major tops form on here or any kind of sort of huge worrisome candles that are forming for us to be overly concerned. So overall, the trend still remains very strong. Yeah, we see these little pullbacks along the way, but ultimately they're bought into. So maybe that'll be the same case again. But we are now starting to obviously see a bit more intervention occur from not just the UK, but we've seen it from Japan and we've seen it from China as well. Will we see it from Europe? Who knows? And US seem pretty set on just tackling interest rate or using interest rates to tackle inflation for the time being. There doesn't seem to be any major concern about the threat to their pension funds or anything like that, like we've seen in the UK. So yeah, a little bit of a pullback, and of course it's having an impact on other currencies. So let's look at euro US dollar. This has been trading in a really neat bearish channel for quite some time now on the daily chart. We've fallen into this major level here at 95.95. Buyers have stepped in. Obviously looks like a bit of a bargain down here based on the long-term charts, but clearly the overall trend remains bearish. So into this oversold move, we have seen some buyers step in, likely to be limited, I think, to maybe around one. So back to parity to tag that, and then maybe the sellers will step back in. Or maybe it could be the start of forming some sort of bottom pattern, but it is going to take a bit of time, and I don't think we can start speculating just yet on that. But yeah, nice couple of days nonetheless. Looking at sterling, obviously we've had the big intervention, we had the big crash at the start of the week, and prices have been moving steadily higher since. So we are now approaching resistance at 114.10. And be interesting to see what sort of reaction we get there. It may overshoot it up to the downtrend resistance line before, again, maybe sellers step in. Or maybe there are a few convinced people out there or participants in the market that believe that the Bank of England have done enough at the moment to stabilise the pound. Still think this level looms pretty large, which is parity. I think having come so close, there may be some attempts in the coming weeks and months to have a go at testing that level. And I think, that would be pretty disastrous if it does, and may see the gilt markets again start falling back to their lows, which, as we heard earlier in the week, that was stressing some pension funds. And some of them on the brink of actually being insolvent. So pretty scary stuff still. So certainly not out of the woods, but this is very much welcome relief, and it may just be some month end or quarter end impacts in there as well. Not going to spend too much time on the currencies because there's not really much that's changed from what we've spoken about previously. So we're going to move on to the indices. Let's take a look at the Euro Stoxx 50 to start with. So that broke down through this major support level at 33.85. Prices remain below it. We closed at the lowest level that we've seen for some time, going back to November 2020 on the Euro Stoxx 50, posting an engulfing candle yesterday, engulfing all of the gains that were made on the previous session. So outlook still remains pretty bearish there. We've got a 78.6% fib level at 32.19 to target on the downside in the short term. Looking at the DAX, up by 0.75% as things stand. Again, another engulfing candle yesterday, closing below that 50% Fibonacci retracement level, which is a pretty negative sign. A bit of a bounce today. I think any rallies are likely to be limited towards this 12,410 level, which was the major support, which should now act as resistance. We saw it do that on the 27th, before then moving to the downside. So it'd be interesting to see what happens on another test of that level if we get one. Ultimately, now we're below this 50% fib level and below this major support. I'd be eyeing up a move down to 11,327, then an extension of that, the 61.8% fib at 11,148. FTSE doing a fantastic job at holding this major support at 68.22. Highlighted here by these blue arrows. We've seen a number of tests of this level, and each time that we have, it's led to some pretty long-legged candles, and the reaction from this level has been pretty strong. We saw this again yesterday. It touched it on an intraday basis, immediately rallying by around 40 points, and we are higher today by around 0.5%. We do have some mild resistance at 69.66 to target, but this is the main level to watch, really, the 68.22 for me. If we get a close below that, then that would suggest that we are about to roll over to the downside. Large top pattern that's been forming over many, many months. And then we can start looking for levels down to 65, 68, which is this 38.2% fib level of the entire post-pandemic move. And then maybe we can start looking for some other levels a bit lower down. But for now, it's holding. And I think if you're a speculator and you're looking for a bargain, trying to buy at this level would not be a terrible idea, but I think you need to have your stops pretty close by, because if this level goes, there's probably a lot of stop losses here that are going to trigger simultaneously, and we could see quite a sharp move to the downside. Stocks. So tech was wrecked yesterday compared to the rest of the markets in the US. It was by far the worst performer in the US. Of late, the Dow has been the worst performer, but the tech stocks yesterday really got a hammering. Apple was leading the charge on the downside, as I'm sure Jamie will come on to in a moment. We posted an engulfing candle yesterday, but these previous swing lows from the 16th of June held pretty much to the tick. And as a result of that, we did see a little bit of relief from that level, and we are posting some gains today, up by 0.82%, although the gains are still within the body of the candle that we posted yesterday. So ideally, I'd like to see a takeout of this high from the 28th, which is around 11,555. And if we do that, then maybe we could see a decent-ish move to the upside. So from a risk-reward perspective now, if you are a buyer of NASDAQ, and wanted to have a fairly tight stop, looking for a bit of relief to the upside, then the risk reward isn't terrible from here. But I would stress that obviously it is the month end and quarter end, so there may just be a bit of adjusting here before we maybe get a further sell-off in October. But yeah, that looks quite interesting to me. So let's look at the S&P 500, the broadest of the US indices. We did see another look below this key support at 3636 yesterday, but we managed to hold above it on a closing basis, posting some gains today, up by 0.65% as things stand. Again, from a risk reward perspective, the fact that this level is holding, is there an opportunity to play a short-term bounce here? The risk reward certainly looks quite interesting, because you've got a pretty clear level there to have your stop at, which is below the low of this candle that we posted on the 28th. And then finally, let's take a look at the Dow. This is lagging a bit behind the other indices at the moment. It does remain below this major, what was a major support, now resistance, this swing low from June. We tried to overcome it. We failed now on a couple of occasions. So that is doing a job that you'd expect really from a resistance level. So quite classic, quite a classic sign that we look for as technical analysts, and it is failing. So maybe here you could look at some sort of spread trade potentially, whereby you'd sell the Dow because it's below the support, which is now term resistance, and maybe look to buy Nasdaq, for instance, if you think that we are going to get a bounce. But that maybe give you a bit of a market neutral position potentially, and spread your risk a bit. So just take a quick look at that actually. So if we were to buy Nasdaq, so what you can do is chart these by doing a divide by Dow price. Let's use the skilling price just because I've used that for the other one. So this is the chart of the two of them together, so the ratio between the two. So if this is moving up, it favors the Nasdaq. If it's moving down, it favors the Dow. So maybe we are forming some sort of wedge here. And if we do see a break to the upside, then that would suggest that we're going to see more upside from the Nasdaq than we are from the Dow. So maybe that's an interesting level to have a look at. A little bit complex maybe for some newer traders, but that is, trading spreads between indices is quite a common method, certainly used in the professional space. So yeah, maybe that is something to look at. That's it from me.
Cool. Thank you, Joe. We'll check out some stocks then, and there was a bit of a battering that took place yesterday. There we go, let me add my chart. But we'll start off with our biggest gainer and loser, as we always do. Our biggest gainer of the day is EVTL, or Vertical Aerospace, which was up 27.18%. Had this nice impulsive move before pulling back, and it looks like we're taking off again. Volume compared to this area here obviously is much lower, but you can see it's still standing out above that 20 period average if we zoom in. So yeah, a pretty nice move there. We'll see if we can find some information. There isn't any. Just 27.18% move yesterday. KMX is our biggest loser. This reported earnings. It's CarMax. Looks like it missed by a fair bit, and it did. This looks, again, pretty nasty at the moment. We've had that uptrend from the COVID lows, and since then had that stage 3 distribution, and now it looks like we're well and truly in stage 4, because highest volume we've seen, including the pandemic actually, coming in yesterday. So a really bad day there, 24.6% down. We'll check out stock heat map. Firstly, I wanted to have a quick look at the month performance of the S&P 500. As we talked about previously, historically a bad month in terms of returns, and that's played out again in 2022 with pretty much everything down. A few names in health technology that did quite well, but the general market, you can see Apple, Microsoft, Amazon, Tesla, all down double digits throughout September. So a pretty bad month overall, which comes as a surprise to no one at this point. Looking at a daily chart for yesterday, though, you can see a pretty bad day as well. Obviously, we've got one more day of the month, don't we? So we'll see that monthly performance might change a little bit, but Tesla was hit pretty hard yesterday, 6.8% down. Apple, as Joe said, down 4.9%. I believe that received a downgrade for the first time in, I'm not sure how long, but quite a while, which saw that move almost 5% lower on the day. But yeah, pretty horrible overall. And yeah, let's go in and check out a few of these. We'll start off with Apple, as we've been talking about it. We noted how the volume was starting to pick up on the downside of Apple, and you can see another high volume day there, high volume sell-off day, crashing through the 61.8 fib, which we thought looked like it might do quite a good job, but off the back of that downgrade, I believe from Bank of America, it's come in much lower, down to $142. At some point, let's see how far down it was. It was closer to 6% down. It did get bought back up a little bit towards the end of the session, but still a pretty horrible day. If we check that on a weekly chart, you can see it's not a particularly nice candle there. I'd expect this to be moving lower and retest these support levels at close to 133 over the next few weeks. Let's check out a couple more. Peloton was a real big loser as well yesterday, down 14.44%. Now, this was a hypothetical idea I think I put up the other day on stream, and if anyone did actually jump in on that, you'd have started off quite nicely because of this really bearish looking candle breaking through support and the volume picking up as well. So yeah, it looks pretty nasty there. Again, we'll look at this weekly. I tell you, we can look at some monthly candles. Yeah, horrible on the monthly, pretty horrible on the weekly, and yeah, no sign of this turning around anytime soon. Let's have a look at NEO. This was down 10% yesterday. Not too much technically to love here. I mean, we've got this support level down close to $13. I think that's probably where price is heading. This has still got much more work to do. We saw the potential for a bit of an inverse head and shoulders forming here, but that never happened, and we're moving steeply lower now. If we got that weekly chart, closing below all these wicks here, so not looking great there on NEO either. Tesla was the other big name that was down yesterday, and this again, we kind of noted how this could play out. We ran into this support level, a bit of a bounce, and then again a pretty aggressive sell-off yesterday, playing out how we thought it might do. Get rid of these arrows now. You can see on the weekly chart, not horrible on a weekly chart. We'll see how it closes today. If we do get a bit more extended selling, then that would be a pretty bad sign. But you know, a bit of profit taking at the end of the month, maybe this holds okay around this area, but we'll have to wait and see. AMD, we've run right into this 61.8 fib from, I think it's a very long-term move. We're on a monthly chart here. So this is from the lows from, where are we, 2015? I think, yeah, 2015. So that's where we're at now. A pretty bearish monthly looking candle there. On the weekly, you can see we've not moved down too much. But you know, we've had 1, 2, 3, 4, 5, 6 of the last 7 weeks have closed lower than it opened. So yeah, not looking great for AMD now. Right at the low this week, and the volume is picking up again on these sell-offs. Qualcomm, we don't need to really look at this again, but here we are. Looks like we're breaking through the neckline of this big head and shoulders top we've seen, that spans across 2020 all the way through to now. So a really big move playing out there potentially, and yeah, I'd like to see, for that bearish argument, I'd like to see the volume start picking up a bit. If we check out this monthly chart, you can see the head and shoulders as well, and we haven't had huge volume yet. That's the kind of thing that can get really accelerated by a big earnings miss or something like that. So we've got the whole of October to go at this point, and earnings look like they're on the 2nd of November, sorry. So we'll keep an eye on that. Well, I won't. Some people will. Netflix, looked at that. I wanted to check out Shopify as well. Had a little look at this earlier, and again, you can make the case for a big head and shoulders top happening here with a really small right shoulder, but the sentiment's still there. You've got this neckline that's held up pretty well, and then this big rounded top pattern, volume really picking up. I mean, that's a really clear one to see. You can see this big volume drop off at the top of this head here, and now it's starting to pick up on these sell-offs now. So it looks like we're breaking through that neckline. So yeah, a lot of scope to move lower on Shopify too. I think that's pretty much it. Unless, have we got any suggestions or anything to look at? If not, I believe we're all good on the stocks for today.
Okay, cool. Right, so there are no other suggestions. Plenty of interaction though on the chat, so thank you guys for getting involved. In terms of the next stage of the video, we can talk about the gun to the head trade. So this is where the three of us pick trade ideas live on the video in the hope that they work out between now and 9 o'clock UK time when we close them off. Alternatively, they will close if they hit the stops and the targets that we suggest. Of course, all of the ideas that we post do have stops and targets because risk management, of course, is of the utmost importance. And this is just a bit of fun, and just reiterate that yet again, we are doing this effectively with a gun to our head. So please don't hold it against us if you do follow us into these trades and they don't work out. But you can check them out on our TradingView profile, signal_center. 3 trades yesterday, and we were selling the Dow. That was the weakest of the US markets, or has been for a little while. So we were selling that. Nice little rejection from resistance here at 29,672. Bit choppy, but ultimately did remain in profit at 9 o'clock. So that was 0.31R on side. Steve was selling the FTSE, big red candle there, when he set his trade yesterday. And he was also on.
Stopped
He was
out.
stopped out. No. Yeah, he was stopped out. Okay, so I'll change that. That was a 1R loss. And Jamie was selling Bitcoin into a resistance zone that he'd highlighted, and you were slightly offside 0.28R on that one at 9 o'clock. So mixed bag, to be expected really, while markets are as volatile as they are at the minute, but we get to go again. And who wants to go first? I don't mind going first.
Yeah, you go for it, Joe. Go.
All right, okay. So I'm looking at the Euro Stocks 600. So this is SXXP. This is the broadest European index, 600 stocks. This is the daily chart. We can see that it's been trading in a corrective channel for some time, broke down through a key level of support at 400 and fallen into this big zone of support here around 380. We have a 50% fib level, and we also have some previous resistance levels turn support. So seems to be holding that for now. Highly speculative, very much going against the trend here, but it is into a massive level. So I'm going to take a look at this. On the hourly, there's a short-term downtrend here, which started on the move lower on the 13th of September, and we've seen a break of this short-term trend line. Not confirmed yet because it's not 9 o'clock. These are hourly candles, so I have to go ahead of that happening. And I'm going to buy it now. It's currently at 387. Stop loss below the low there, which means I have to target something pretty lumpy on the upside in order to make sure the risk reward is worthwhile. So let's go into a few of these lows here to give me a 2-to-1 risk reward ratio. Looking for a move back above 400, 403 to be precise is the target. Entry 387, stop 379. So that is my trade of the day, hoping for a bit of window dressing from some of the funds to try and push these indices up as we approach the end of the month and the quarter. Who's next? Go on, Jamie.
Yeah, sure. So I'm having another stab at indices. I had a go at this earlier in the week and it didn't pay off as well as I'd hoped. But same kind of idea as Joe, a bit of window dressing from some of these funds. We've got this RSI divergence, which we noted throughout the week on the daily and the 4-hour chart, and you can see it quite clearly on the hourly chart. So that's when the chart makes a lower low, but the RSI in this case makes a higher low, which shows possibly a little bit of a turnaround in the short term. So with that being said, I'm looking to buy the Russell 2000 today, targeting a 38.2% Fibonacci retracement from this leg lower. Also got the 20-day EMA on my chart, a bit of a tool used for a bit of to measure some mean reversion. So we're hoping that we do get a bit of short-term buying today, so that this one plays off quite nicely. So yeah, looking to buy Russell at current price, which is 16.94. So let me just change this a little bit. We'll keep the stop pretty tight, just under this recent swing low here. So we're going to hope this takes off from now. That will be at 16.67. There we go. And then yeah, take profit, like I say, at this 38.2 fib, which will be 17.50, we'll call it. So pretty conservative 2.07R risk reward there. But yeah, hoping for a bit of a move higher on the indices to end the week.
Over to you, Steve.
I'm going to look at S&Ps. It's stalling around the previous level, and I'm buying indices. So the fact that I'm buying indices, there is something out there that's saying maybe we're going to correct higher. I never buy indices. I hate it. The June low was 36, and we've stalled just below there, made a new low, so flushed out a few longs, and starting to pick back up again. So apart from that, I think the price action on the daily chart has been sort of a bit inconclusive, bit undecided around here. We're getting it looks like a bit of a bottoming diamond type formation anyway, so it could break either way. But yeah, looking for a break to the upside on this. The 4-hour chart looks pretty positive, bullish engulfing on the 4-hour chart. So yeah, buying. Oh, where are we? Buying at 36.70, targeting 37.70, and the stop at 36.40. So 30 tick stop against a 100 point. Oh, we could actually just go 3-1 on this. 37.60 will target. 3-1 risk reward on the S&Ps.
Okay, good luck. So 3 indices to buy at the end of the month. Feels a bit crazy saying that, but that's what we're seeing on the charts, and hopefully you agree with the rationale that we've come up with there on those ideas. If you do want to follow the progress, then obviously do that via the TradingView profile. They'll all be posted up very shortly. In terms of the day ahead and what we can look forward to on the economic calendar front, at 10 o'clock UK time, we've got the Eurozone consumer prices. So that will be a fresh read on inflation in Europe. Going by what we saw in Germany, prices jumped pretty significantly to fresh record highs of 10%. So maybe Europe will see something quite similar. Then later on today, we have the PCE prices index in the US, which is at 1:30 UK time. Then we look forward to next week. On the 3rd of October, we have the US ISM Manufacturing Index. We have the Reserve Bank of Australia rate decision on the 4th. Then we have non-farm payrolls on Friday, the 7th of October, as well as the Canadian employment report. So more data for us to look forward to next week. And of course, we are going to have more volatility as markets continue to be very volatile due to the underlying economic conditions. Okay, anything to add, gentlemen, before we wrap it up?
No, all good. Have a good weekend, everyone. I'll see you in a week or just over.
Yeah, have a lovely, relaxing week, Steve. And Jamie, you'll be here until Tuesday, so we'll see you on Monday. Have a great weekend, everybody, and thanks for watching.
Toodaloo.
Bye-bye.